Good afternoon, I am Roniel, Zonio, your reporter for today. I will discuss carrying charges. So what is carrying charges? It is an installment customers expect to pay. It is a cost associated with holding a physical commodity or financial instrument, sometimes called as a service charge. Carrying charges includes insurance, storage, interest, and the investment funds. Some firms state their carrying charges in pesos, cents, and as well as in percentage. It is good business also to tell your customers about prepayment privileges, refund rates, if he pays the balance before maturity. It will discuss more fully in Truth in Lending Act and Usury laws. So Truth in Lending Act is a federal law enacted in 1968 to help protect consumers in their dealings with lenders and creditors. Usury laws are regulations governing the amount of interest that can be changed on a loan. So it is not always easy to determine the carrying change. It should be reasonable but adequate to defray the cost of the transaction. But what is reasonable? Reasonable is having sound judgment, fair, and sensible. What are actual costs? The actual cost is the amount of money that paid to acquire a product. People should feel that the installment purchases is paying its own way. Otherwise, cash customers may think they are carrying an undue burden. On the other hand, excessive carrying charges may drive away installment buyers. Neither group wants to exploit it. The best policy: beware of charges that border on being unethical.
Good afternoon. I am Princess Karl S. Tuga, and the next topic is all about the credit investigation. So, the credit investigation is a process by a financial institution to capable the client's capability to pay back the loan. So, if the clients failed to pass this process, it means the loan is disapproved or rejected. So, sinusigurado nila na ang kanilang kliyente ay may kakayahang magbayad ng utang. When a clients apply from a financial institution, the clients need to tell the details about how much their salary and their other source of income. And the client's details will be verified through a credit investigation, which might include to confirm the client's income. So, tinatanong ang isang client kung ano ang pinagkakakitaan at kung magano dahil bine-verify ito through credit investigation. Credit investigators do is they check the credibility who applies for financial institutions, and they also analyze the data provided by the customer. Yung credibility is kung believable sila na may kakayahang magbayad. The credit qualities to investigate is merong 5 C's of credit. First is the capacity, second, character, third, collateral, fourth, capital, and the last is the condition. The capacity is your capability to pay. Character is the responsibility of your actions. Collateral is assets as security for the loan. Capital is the cash that you are willing to spend. And condition. So, they use this to rate if a client is qualified for a loan. So, itong 5 C's ang mga basehan nila para ma-qualify yung loan ni client. And that's the end of my report about credit investigation. Thank you.
Good day everyone, Jannine Dionisio, and my topic is about form of contract. So sales are made on conditional sales contract on a chattel mortgage basis because such risk is fairly large and financing is extended over a long period. So, conditional sale is similar to hire purchase. The agreement usually includes the condition that the goods don't belong to you until you've paid the final installment, and the lender may be able to repossess the goods if you fall behind with payments. So, what is a conditional sale agreement? It is a financing arrangement where a buyer takes possession of an asset, but its title and right of repossession remain with the seller until the purchase price is paid in full. In here, the purchaser can take possession of the property as soon as the agreement is enforced, but does not own the property until they have fully paid for it, so which is usually done in installments. So, if the business defaults on its payments, the seller will repossess the item. A conditional sales agreement is a contract that involves the sale of goods, also known as the conditional sales contract. The seller allows the purchaser to take delivery of the items outlined in the contract and pay for them later. So the rightful ownership of the property belongs to the seller until the full price is paid by the buyer. So many conditional sales contracts involve the sale of tangible physical asset, sometimes in large quantities. So this includes vehicles, real estate, machinery, office equipment, tools, and fixtures. Conditional sales contracts are typically used in real estate because of the stages involved in mortgage financing. So from pre-approval, appraisal to the final loan, in these contracts, the buyer can generally take possession of and use the property after both parties have signed and agreed on a closing date. So the seller, however, generally keeps the deed in their name until financing has come through and the full purchase price is paid. So, strong contract layout details of the nature of the deal between the buyer and seller and are ready for review both parties to sign once they are able to come to a verbal agreement. So, contract should be as specific as possible and outline the following criteria. First is the property type. So, the nature of the assets in question, their condition as well as the quantity being transferred to the buyer. Second is the payment. It is the amount of the deposit or down payment required by the buyer to secure the property from the seller. And third, interest, because payment is being made in installments. So, the buyer will also outline the amount of interest it intends to collect during the length of the contract. Another is delivery. It is how and when delivery of the property will take place. The title transfer, it is the date by which the title should transfer to the buyer as long as the conditions of the contract are fully met. Default, the details of when the buyer is in default of their obligation. Repossession, the contract should also describe the procedure for the seller to recover any property. So the benefits of conditional sales agreement. So acquiring property through a conditional sales agreement may allow a business to deduct the interest expense on its tax return. A conditional sales agreement may not require a down payment and may also have a flexible repayment schedule. Other benefits to a buyer includes giving the buyer access to an asset before full payment, which can create financial leverage for a business. So another benefit is conditional sales agreement also protects the seller if the buyer defaults on required payments, since the title does not transfer to the buyer until the completion of the condition. The seller remains the legal owner. What is chattel mortgage? Referred to as security agreement. So it is a loan used to purchase an item of movable personal property such as mobile or manufactured homes where the homeowner buys the residential unit but not the land that it occupies. It is often financed with chattel mortgages. So another is heavy business equipment like a bulldozer or forklift also can be purchased by using a chattel loan. Chattel loans are often more expensive than traditional mortgages, but low interest. Government-backed loans are available to some borrowers. So a chattel mortgage differs from a regular mortgage in which the loan is secured by a lien on a stationary property such as a house or office building. One of the types of chattel mortgages is equipment loans. So business frequently use chattel mortgages to purchase heavy equipment for construction, farming, or other purposes. Heavy equipment tends to have a long lifespan and be expensive, so a chattel mortgage allows the buyer to use the equipment while the lender retains an ownership interest. So The lender can recover the equipment and sell it to pay off the loan balance if the buyer defaults. So, chattel mortgages are used to purchase new and used equipment. Benefits of a chattel mortgage. So, a chattel mortgage may be the only way for a prospective buyer of manufactured housing to afford their home. So, in the case of commercial borrowers, a chattel loan will allow them to buy an expensive piece of equipment that otherwise could be out of reach if they had to pay cash for it. Disadvantage of a chattel mortgage. It tends to carry higher interest rates and have fewer consumer protections than regular mortgages. So, they have shorter terms, so monthly payments can be higher. So in forming contract, you should check out laws for first filing and recording instruments. So the recording of a mortgage shall be effective by making an entry which shall be given a correlative number setting forth the names of the mortgagee and the mortgagor, the sum or obligation guaranteed, date of the instrument, name of the notary before whom it was sworn to or acknowledged, and a note that the property mortgage as well as the terms and conditions of the mortgage is mentioned in the detail in the instrument filed, giving the proper file number thereof. So, the recording of other instruments relating to a recorded mortgage shall be effective by way of annotations on the space provided, therefore, in the registration book, after the same shall have been entered in the primary entry book. Second is conditions to repossess. So lenders must use repossession only as a final resort, and there is an agreement that the major lenders won't commence repossession proceedings until at least 3 months of errors have occurred and refer you to independent debt advice. Cost and other provisions. So registration of chattel mortgages and fees collectible in connection therewith. So every register of deeds shall keep a primary entry book and a registration book for the chattel mortgages, shall certify on each mortgage filed for record as well as on its duplicate, the date, hour, and minute when the same was by him received, and shall record in such books any chattel mortgage, assignment, or discharge therefore. So, any other instruments relating to a recorded mortgage and all such instruments shall be presented to him in duplicate, the original to be filed and the duplicate to be returned to the person concerned. Then you can decide which type of contract to use. Legal remedies, it refers to monetary damage awards, such as compensatory, special, nominal, and liquidated damages. So, when compensatory damages are awarded, a court orders the person that breached the contract to pay the other person enough money to get what they were promised in the contract elsewhere. Or both judicial and extrajudicial. So, the judicial, which puts an end to a pending litigation, and the extrajudicial, which is to avoid a litigation. That's all. Thank you.
Good day everyone, I am Katie Ganancial, the fourth reporter of Group 5, and today I am going to discuss about the expenses and profits in installment selling. So in expenses and profits in installment selling, you will have a certain expenses to pay before you can make a profit from your installment operations. So bago ka makagawa o makakuha ng kita mula sa pagpapatakbo ng isang installment selling, ay kailangan mo munang magkaroon ng mga gastos na babayaran mula sa pagpapagawa o pagpapatakbo ng isang installment business. And next, what are some of the expenses connected with installment selling? Among them are, first, we have salaries for people to run your credit operations. So, isa sa mga expenses ng isang credit operations ay ang pagpapasweldo sa mga tauhan nila. Like for example, sa mga home appliances company, meron yan sila mga collector na sumisingil sa mga tao na kumuha ng mga installment appliances sa kanila. And second, we have expenses of office space, supplies, and utilities. You may not have to rent additional space, but you will have to consider the sales you might have made in the space devoted to credit operations. So, as well as sa mga gastos sa office space at sa mga supply ng mga utilities or renta mo ng pwesto. If ever naman hindi ka nagrenta ng pwesto, you have to consider yung gastos at ang benta mo para matuunan yung credit operations mo. And third, we have collection and reposition expenses. And last, interest on money borrowed to carry on your business. So, ito yung interest na nakukuha mo sa pagpapautang para may pagpatuloy mo yung negosyo. So, bali dito is naruruling lang yung pera. And The longer the contract, the larger the amount of money you will have to tie up in receivables to do a given amount of installment business. So ito yung kapag mahaba yung kontrata, which agreed by both buyer and the lender, is mas maraming pera din ang kakailanganin ng isang nagpapautang para mapunan yung kulang ng isang installment business. And you will also have the advertising bills of announcing and promoting the plan. So gagastos ka rin sa mga advertisements sa pagpapara ng isang installment business, like for example sa mga announcing and printing flyers and promoting in radio or televisions. So that would be all. Thank you and God bless us all.
Good day everyone, I am Aljun Joseph A. Tugade and I am the last reporter of Group 5. So my short report is just the continuation of the previous topic about the expenses and profits in installment selling. A little recap: what is installment selling? It is the process of selling goods or services with or without immediate part of payment on a contract. From the perspective of the seller, revenue and expenses under installment sale are recognized at the time of cash collection rather than at the time of sale. This way, the borrower knows the number of payments he or she needs to pay monthly or yearly. So, some examples of installment credit are mortgage, car loans, student loans, and personal loans, and many more. Things to remember: if you are selling on cash and an open charge and add installment credit, you will have the problem of dividing expenses connected with installment selling from those resulting from open charge accounts. Next, you offset such expenses by selling more. Gross profit on installment sales should pay for the program and leave more net profit than you could have with only cash sales. Customers help to cut expenses by paying a service charge for the privilege of buying on installment. This charge varies with various stores. To summarize everything, so here, the seller or the lender sells their goods or services to the borrowers on cash or open charge or on installment credit. So when we say open charge, it is to charge something to someone's account so they can pay for it later. So usually there's interest rate in it. And when we talk about the installment credit, the lenders gives the borrower a lump sum and fixed scheduled payment made until the loan is paid in full. So it depends on the agreement between the lender and borrower if how much money the lender will lend and how much is the interest. So if the borrower failed to pay, there will be a penalty charge to his or her account. And also, lender offer lower interest rates for borrower who have good credit score and history. There would be a problem dividing expenses in installment selling because, for example, you as a lender sells good on cash or open charge or installment credit, it will affect your profit in the business. So if the borrowers or buyers fail to pay the amount at a specific time, it will affect your installment operation. For example, the money or interest you earned in your installment business is you use it for the rolling of your business, or if the money supposed to pay other appliances, so it will affect and cause problem if the buyer or borrower failed to settle their payment on time. So at the end of the day, you as a seller or lender will suffer a lot if the buyer or borrower was not able to pay up the amount. That's why some installment business suffer losses and worse, bankruptcy in their business. So as a lender, you have the responsibility to inform your buyers to pay on time to avoid any problems, and you as a borrower, you have to pay on time.